But I do think that they will certainly stockpile silver. I think that may lead to other nation state asking the same question. Well, if it's strategic to the U.S., is it strategic to us? So there could be other nation states that are saying, hey, wait a minute, we love gold for monetary purposes, but we need silver for strategic reasons. Maybe we should jump in there as well. Just for final statement on that whole idea.
If you try to trade something like silver, try to go in and out, then your stress level just goes through the roof because silver will kill you. There's gold's fundamentals, it's got to go up to $15,000 or $20,000 an ounce to be able to make the next global currency system possible. So, same thing with gold.
The United States has formally designated silver as a critical mineral as of August 2025. A move that authorizes the government to rebuild a national stockpile for the first time in over 20 years. In February 2026, the Trump administration announced Project Vault, a $12 billion strategic minerals initiative intended to secure domestic supplies and reduce reliance on foreign imports, particularly from China. Gold and silver bulls have somewhat stabilized prices and stopped the bleeding, which favors the bullish camp. What is important, technically, at present, is that gold and silver prices hold above solid chart support levels at the February lows. Financial commentator and economic strategist DavidMorgan and JohnRubino discuss the interplay between monetary policy and commodity markets, with a focus on gold and silver. DavidMorgan notes that physical silver is overtaking paper markets, driven by strong global demand. Unlike the 1980s hunt era, today's market is larger and more robust, with demand roughly double past production levels, signaling that the physical market will ultimately dominate. The U.S. Strategic Silver Reserve is currently a void, but DavidMorgan argues that a refill is inevitable. Regarding new retirement plan rules, expert points out that some U.S. 401k programs, including large corporate plans, that can now add gold and silver as investment options. He suggests that if even a small share of participants allocate 5 to 10% into metals, it could generate steady, long-term physical demand. While discussing the gold-silver ratio, Morgan shares that some of his members swapped silver for gold when the ratio tightened near 50-1, locking in gains. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from DavidMorgan and JohnRubino's recent interview.
Gold is the ultimate money. I know it, you know it, our followers know it, and the banks know it. Now, who else knows it? Well, Wall Street's probably known it for a great long time, but they've never stated it before. But what happened last year? You had stalwarts on Wall Street that used to kind of make fun of guys like you and I. And now they're saying it should be 20% of your portfolio, 10% of your portfolio. Institutions should be involved, pension funds should be involved. 401ks, defined benefit programs could add silver and gold. And now you've got silver, switching to silver in this critical minerals list. So there are so many factors. And the last factor is what happened at the end of 2025. And it was a paradigm shift. What took place is something that Peter Schiff, myself, and many others in our arena have said, that once the physical metal took precedence over the paper paradigm, we would have a brand new market. It did. And we had it for several months based primarily on commercial bars, which are backed by paper, being added to industry, perhaps private hands, both, to take control of the price. So we had a price discovery going on for a very long time. But as that physical methodology did take control for quite some time, the paper paradigm kept building and building, which you already addressed earlier in our first question out of the box. But nonetheless, now we have a struggle. Who's going to win the battle? Well, the physical market will win the battle. And that's why I'm so bullish that we still have not ended this. It's not a 1980s. Hunt brothers, get brought up before Congress and have to testify, and they're banned from ever trading silver again the rest of their lives. And there was too much paper in that system. There's probably too much paper in this system. The problem this time, different than the Hunts, is that the physical demand is so strong, unabating, and rules are changing in China, as far as I understand it, as far as how much leverage you can use at the downside. So there's a lot of factors this time that weren't around. And the last one is very obvious, but it remains to be stated. You had a Hunt brothers and some Saudis involved in the 1980 market. Today, it's a global market. Solar, AI, EVs, all electronics are leading that market. It's a 65% demand that isn't going to go away. Whereas if you look back in 1980, I forget the exact number. I know that in 1990, it was about 30% of the market. Now it's double that amount at least. And the supply chain was about 500 million ounces annually. And now it's about a billion ounces. So it's twice the demand on twice the amount produced. So that's a lot more metal that's demanded today than there was back 25 or back in 19. I had Mike Dorenzo, the CEO, president of the Silver Users Association, on our mastermind. And I asked him that question. He kind of picked up his voice. He didn't yell at me, but he said, "There's nothing that says they have to stockpile it." Then he kind of calmed down. And, I believe that they will. And he said yes, that, just because it doesn't say they have to, he thought that they would as well. But the question becomes how soon and how much, So they're going to grab, 100 million ounces in a year's time, or they're going to grab 30 million ounces in 3 years' time. We don't know the answer to that. But I do think that they will certainly stockpile silver. I think that may lead to other nation state asking the same question. Well, if it's strategic to the U.S., is it strategic to us? So there could be other nation states that are saying, hey, wait a minute, we love gold for monetary purposes, but we need silver for strategic reasons. Maybe we should jump in there as well. Just for final statement on that whole idea, the strategic stockpile was 139 million ounces in 1985. They used that to make the Silver Eagle or coinage program. And it was depleted over several years. And then they had to go to the open market to buy silver to make Silver Eagles from that point forward. I'm not saying that they're going to try and get 140 million ounces, but maybe they're going to try to get more. I don't know. I would say round numbers, I would think at least 50, if not 100 million ounces. Now, again, how fast? Because they do it over 10 years, it's really not going to put a lot of pressure on the market. It'll put some. But if they're trying to get 50 million ounces per year for the next 2 or 3 years, that may be enough. We just don't know. It's all markets move at the margin, but the more demand there is, and for physical, the more the price control goes back to the physical side. And last thing you didn't ask is that in the United States, I think it was February 1st, Kai, the defined benefits program, in other words, called 401ks in the United States, can add, not necessarily they will do it, but some will, gold and silver as an option for the savings plan. So that is a big market. These are big corporations that have these pension programs for employees. I mean, we're talking like Ford Motor Company, General Motors, 3M, Dow. I mean, all these big corps that have lots of employees that have the wherewithal to do these type of things. So that's a lot of pent-up demand that someone that's worked there for 20 years, 30 years, 5 years, just entering the workforce says, wait a minute, my option stocks, bonds, money market, or gold and silver? Hey, I want 10% of my program going into gold and silver. Well, multiply that times the amount of people that would be steadily, consistently buying gold and silver month over month, year over year, and what that would add to the physical demand. I think it's important to bring that to the fore. Being so bullish silver for so many years, but more data, more information. You've got to do the late great Ayn Rand, check your premises. One of my premises back 25 years ago, and probably for the first 10 years, was, silver is a monetary metal, and it still is, but less and less a monetary. So I put out a guidance outline for my paid subscribers about silver going to 100 and what you could do to filter out at a profit. And also on the gold silver ratio, and I started that at 60, and I went to 50, and I went to 40, went all the way down to the possibility of maybe 20. But the market knows more than anyone. And if you do the guidelines that I outline, not a lot, but a fair amount of my premium members did swap. They swapped gold in for their silver at the 50-to-1 ratio. Well, they look like a genius today. Will they look like a genius a year from now? I don't know. But the way I set this up, they could swap back if they wanted to. I mean, let's say the ratio got down to 80-to-1, or we could say up to 81, depending how you look at it. You might go, wait a minute, I made this much on my swap. I'm going to swap back gold to silver because I think David's right. I think it's going to get below 50 again. I'm not trying to be a trader here, Kyle. I'm suggesting is that you have to have a plan. If you sit there and think that, I'm going to catch the top on a whim because I'm emotionally attached to my investment that feels like it's the top, good luck, especially in this kind of a market. And the last thing I want to say, because I think it's critical, is that, and I have to take a deep breath, I'm not trying to be dramatic, but if we do go to a hyperinflationary environment, the last thing you want to do is sell your metal. It doesn't mean you got to hold it all the way up. I mean, if you bought silver at 50 and went to 100 and you sold half and have a free trade, in other words, all the silver you're now holding is sitting there for quote unquote free because you got your original capital back, then why not, be smart with it? So there's lots of ways to approach markets, as you know, but I think that, again, you must have a plan. If you don't have a plan, you're going to get hung up in the emotional wave, because once silver hits, let's say 150, there'll be people saying it's going to 300. And maybe they're right. And if it hits 200, there'll be people saying it's going to 1,000. I mean, there's people out there saying that now.
The recent dip in metals was a perfect storm of timing and leverage. With the Chinese market closed for a holiday, a massive source of physical support vanished, leaving a liquidity vacuum that U.S. futures traders were happy to fill. Seasoned expert JohnRubino highlights how this allowed the COMEX to dominate the price action, using margin adjustments to force a temporary retreat. But as Rubino points out, when $72 silver feels cheap, the structural bull market is still firmly in control. In his analysis, Rubino argues that the current volatility is a distraction from the endgame of fiat currency. Rather than trying to catch every 5% swing, he recommends building a steady core position in gold, silver, and copper. When you consider that a global debt reset could push gold to $20,000, today's price movements become irrelevant. Investors are treating gold as an insurance policy against the potential collapse of conventional asset markets under the weight of record government debt. Let's jump into the interview.
It's hilarious to be talking about precious metals as crashing, like all the way down to 4,900 for gold and 72 for silver. Those would have been paradise prices just a couple of years ago. So it's a measure of how wild the precious metals bull market has been, that it feels almost catastrophic to be at these, historically incredibly high prices, just much lower than in the last few months. And first of all, it's to be expected that when you have a huge run like gold and silver have had in the last year, that you get a correction. That's just normal. There's an awful lot of people with profits to protect, and selling is one way you protect your profits. So a correction is to be expected in this kind of a bull market, and they happen in all bull markets. And you've got the ever-present manipulation going on out there, where COMEX raises the margin requirements to an unreasonable level, and that pushes down the price, or that dries up activity in the futures markets and causes the price to go down. That's happening too. And now, right this minute, this week's crash is mostly because the Chinese markets are closed because of a holiday, and they don't reopen again until the 24th. Today is the 17th, and they open again in 6 or so days. And that just leaves the US-based futures contract speculators to play in this market, and they've decided to smash gold and silver, as we expected, because the COMEX and the other exchanges here are running out of physical silver, so they really need to strangle activity, especially the kind of activity where people are standing for delivery on futures contracts. And so this is a chance sent by heaven for them to lower the price of silver to the point where it's not an issue. They're not going to be drained dry in the short run and then have to default. So all of that stuff is going on, and most of it will probably reverse out once the Asian traders come back in, because they're basically buying physical for industrial uses. And the solar panel guys still need the silver they need. The electric car guys still need it. The world's military industrial complexes out there all need silver for their missiles, and so physical is still going to be in demand. The price pressure will probably be to the upside once China comes back online, and we'll probably forget about this week. It'll just be a squiggle in the context of a long-term bull market. So the question is, should we be bottom fishing here It's just so hard to call these things, these prices, the bottom. I looked at SIL, the big silver miner ETF, thinking maybe I'll grab some cheap shares here, but they're still not cheap. You know, they're double or triple where they were a year ago. So bargain hunting just doesn't feel right at these price levels. So I'm just sitting on the sideline waiting for all this to play out. There's so many rumors about who has what out there. You know, how much short JPMorgan Chase is, or how long they are, and everything. And I don't really have any good information on those rumors, so I don't know who's short or who's long. But it's completely possible that there are some big shorts out there who are desperate to be able to get out without being crushed. And that the manipulation that's going on now is at least in part due to that big short position out there, and is designed to help the big shorts. We'll have to see. I really don't know. And I have a lot of trouble with these short-term moves because they're very hard to predict, and nobody really knows anything. Nobody has perfect insight into what the guys either manipulating or going in big for industrial reasons or whatever are doing in the moment. And I think that it's a lot psychologically healthier to be looking at the long-term movements or the long-term fundamentals for these industries. Silver's in shortage right now. We don't produce enough to cover the silver that's being bought. And that's been that way for several years. And it's only increasing. You've got these new batteries coming online that use more silver than the existing electric car batteries. And today's next generation solar panels use more silver than the last generation. So there are a lot of reasons to expect the silver deficit to grow and to turn into panic buying at some point. And that's the fundamental fact of the silver market. We just don't have enough silver. And there is massive demand for it on the horizon. And historically, that's the kind of thing that leads to big increases in price. So if you stay focused on that and keep dollar cost averaging and using lowball bids to get things as cheaply as possible, then you're okay financially and psychologically, because otherwise these what are going to look like squiggles 2 years from now, but these really massive moves in the moment will drive you crazy. And what you don't want is to be driven insane by your money. Your money should be working for you and should be lessening the stress in your life. But if you try to trade something like silver, try to go in and out, then your stress level just goes through the roof, because silver will kill you, or any kind of highly volatile market. Like if you try to trade in and out of AI stocks, which a lot of people do, a lot of people go in and out of NVIDIA and stuff like that. Well, sooner or later, you're going to be driven insane by that, because the stress will just become overwhelming, because you'll be so wrong with so much of your net worth. So just don't do it. Add gradually to these sectors and these commodities that have really good long-term prospects, like copper. The copper story is great. We're going to need, there's one speech that keeps showing up on YouTube where somebody big in the copper space says, we're going to need to find as much copper in the next 18 years as we found it in the previous 3,000 years. And we aren't going to be able to do that. So when you have those kinds of fundamentals in the market, you should be very comfortable just gradually adding to your positions. And of course, gold. Gold is obviously something that has phenomenal long-term prospects, because the world is inflating away all the big fiat currencies. And when that happens, historically, everybody piles into gold, and we'll probably have to go back to a gold standard. We'll have a currency reset that is, possibly a gold standard, or at least will involve gold in some way. And when that happens, it has to be at a much higher price. So there's gold's fundamentals. It's got to go up to $15,000 or $20,000 an ounce to be able to make the next global currency system possible. So, same thing with gold. Add gradually. You don't have to play the squiggles. Just buy what you can when you can, and let the fundamentals play out.
Short-term volatility, holiday-driven liquidity gaps, and margin maneuvers may rattle traders, but the long-term fundamentals of the metals market remain firmly bullish. While gold is projected to serve as a stable anchor for portfolios, silver is expected to act as the high beta variant, likely delivering stronger percentage gains due to severe industrial supply deficits. Are you positioning for the short-term swings, or are you building a core portfolio that rides the long-term wave of silver and gold as strategic insurance-backed assets? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.